Over the past year, there have been actions and decisions in the private markets that has created noise. And recently, there's been increasing noise around private markets. Headlines pointing to stress in private equity, inferring weakness, instability, and uncertainty. As this contagion moves through the market, recent concerns are now in private credit, refueling discussions about defaults, redemptions, and liquidity. For many investors, this begins to feel like one unified story about private investments. But that's where confusions can begin as this contagion spreads. When markets get noisy, it's easy to generalize and take pressure in one part of the market and apply it across everything else that looks similar. But clarity and informed decisions come from separation and analysis. Not all private investments operate the same way, and not all are exposed to the same risks. Much of what's been discussed today is concentrated in private credit, often tied to higher risk lending, particularly in sectors such as technology or emerging growth. These strategies are more sensitive to interest rates, refinancing conditions, economic stability, and short-term borrower performance. When those shift, stress can show up quickly through defaults or redemption pressures. That's not where Skyline operates. We are not a private credit lender. We are long-term owners of real assets, assets that are tangible, income-producing, and essential. Our portfolios are built around what Canadians rely on every day: housing, essential retail, food, health, and services, industrial space that moves goods, and electricity generation. These are not driven by market sentiment. They are needs-based and consistently in demand. Just as important is where we invest. Roughly 70% of Canadians live outside major urban centers in secondary and tertiary markets. These communities tend to be less speculative, more balanced, and more grounded in local fundamentals. That has been a key source of stability in our strategy since the beginning. We focus on long-term ownership, active asset management, and stable cash flows from essential assets. So as an investor, when you encounter this type of noise, the questions to ask are simple. Have the fundamentals changed? Have the assets changed? Has the long-term need for these assets changed? Because throughout this series, that has been constant. From the very beginning, we acknowledged the noise, the headlines, the volatility, the uncertainty, but we also stepped back and reiterated on what matters: your objectives, your time horizon, your risk profile, and the fundamentals that underpin the investments themselves. We explored what it means to find the quiet. And we reinforced a simple idea: not all market stress is universal. Not all investments should respond the same way. And not all noise requires action. In our view, within areas of focus, the fundamentals remain intact. The need for housing remains. The need for food, health, and services remains. The movement of goods remains. The demand for energy remains. These are not short-term trends. They are long-term realities. Noise will always exist. It will ebb and flow. But clarity in investing comes from the confidence in knowing what you own, why you own it, and whether anything meaningful has truly changed amid the noise. At Skyline, our focus and delivery remains unchanged. Essential assets, resilient markets, long-term discipline. That is where we continue to find quiet, and where we believe investors can too.